If tech stocks surge in the first 3 months of the year, the housing market is in trouble. If gold rallies in Q1, don't expect real estate to thrive in Q2. This isn't guesswork. It's not even economic theory. It's backed by hard data from the past decade. And these numbers tell a story that many people are completely missing. So I tracked 3 major asset classes, the S&P 500, the Nasdaq, and gold. And I saw how they performed in the first quarter of every year from 2015 to 2025. Now, I will say I excluded COVID year 2020 because that black swan event creates a massive skew effect. But if we look at how US home prices shifted in that same period, and in the quarter right after it, so we're looking at Q1 compared to Q1 for housing versus the S&P, Nasdaq, and gold, or Q2 for housing versus those same markets. My goal was really simple: uncover where the early year investment trends say something about where the housing market is headed. And the results were a lot clearer than many might have expected. So let's start with the first comparison: Q1 returns for each asset class versus Q1 change in home prices. Now, I must mention I used the Case-Shiller Pricing Index for housing, and what we saw was the following. When the S&P 500 went up in Q1, home prices usually didn't. The correlation, in fact, was around 0.5 negative. That's a moderate negative relationship, so that's nothing particularly major, but it's still something. But when the Nasdaq surged, the inverse correlation got much stronger with a negative 0.76 correlation. And what that means is it's substantial. The faster tech stocks rose, the more home price growth slowed or even reversed. In contrast, gold showed almost no correlation in Q1, and that means gold didn't really track with housing during the same quarter. What this tells us is that when investor excitement is high early in the year, especially around growth and risk, which is what tech tends to be, the housing market tends to lag. Home buyers pull back, sellers adjust expectations, and confidence shifts. In Q1, stocks and housing often move in opposite directions. Now, when it comes to the plots, when you have a look at the plots we've included with this, you'll see some simple scatter plots with a line through the middle. And here's what you need to know. If the line goes down, it means one thing goes up while the other goes down, i.e. they move in opposite directions. So when we saw a negative correlation for the Nasdaq and housing, that's what this means. If the line goes up, it means they generally move together, but we haven't seen this at all. And if the lines have this situation where the points are tight around the lines, it means the relationship is strong and consistent. If the points are scattered all over the place, the connection is weak or uncertain. So you don't need to be a statistician to understand that. Just look at the direction of the line and how tight the dots are. And you can see that when it looks at the Nasdaq and housing, there is a very clear negative correlation. Now, let's talk about the lagged effect. Maybe housing takes time to react. Real estate is slower. People don't buy a house overnight. So let's look at 1 quarter later. Let's compare Q1 asset returns with Q2 changes in US home prices, again using the Case-Shiller Index. And this is where things got really interesting. The S&P's influence faded massively. It's weak and barely worth noting. The Nasdaq's influence also dropped with a negative 0.33 correlation. So that's still negative, but less predictive than the larger effect we saw in Q1. And in Q1, remember, we had a negative 0.76 correlation. So that's very strong. Gold, on the other hand, gold got louder with a negative 0.63 correlation with Q2 housing prices. That is strong. So when gold rallies in Q1, there's a good chance the housing market will cool off in Q2. This might reflect a fear-driven shift when investors flee to gold and may be sensing trouble. And that trouble seems to show up in housing just a few months later. Gold in this case is a warning sign. So this isn't about timing the housing market, not even about predicting the exact price changes in the market. It's about recognizing that markets move together or apart in ways that reflect deeper patterns in sentiment, risk, and behavior. So when tech stocks rally, capital gets pulled out of real estate. When fear creeps in and gold surges, home prices often fall next. And when everything looks too good to be true in Q1, this might exactly be when housing starts to slow. So understanding these connections won't make you a fortune overnight, but they will make you smarter, more aware, and better prepared. Because real estate isn't just about location, it is about timing. And right now, the timing speaks volumes. So the next time you see the Nasdaq flying high or gold breaking out in the first 9 days of the year, don't just think about your portfolio. Think about the housing market because the signals are there and the story they're telling, it starts in Q1. It might be house buying season, but be prepared to know what's going on when these markets move like this. Thanks for watching this video. Hope you enjoyed this, and I can't wait to see you in the next one.